Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
Thanks for listening to the show this week. This is our about 2 months on the podcast, YouTube. We email it to people. If you have any friends that you think might benefit from this show that's been on for 20-something years, don't hesitate to call us. We'll put them on our list. You can always find it on YouTube and all that stuff. But it's nice to just have it in your inbox, in your email every week. Our number is 972-715-2424. Again, 972-715-2424. All right. The news this week, the best news, Guy.
Yeah.
Social Security is going up 2% next year. If you ever looked at the history since 1946 or something, it's gone up an average about 3.8%. But the last 5 years, we had 2 years with nothing.
Much lower average, right?
Last year, it was 0.3 increase. So this is the highest increase since 2012. And you remember a couple of years ago, they changed the way they calculate the inflation. They call it's a different inflation rate they're using. They took out like energy, because at the time, remember, take yourself back 4 or 5 years ago, oil prices were going up like crazy.
It's still a CPI though, isn't it? They just are rotating what the inflationary items out and putting less inflationary items in, right?
Yeah,
like beef and oil and.
It's called the Consumer Price Index for Urban Wage Earned.
There's a suffix.
They made up one.
There's quite a suffix on it.
Honestly, they just made one up. They said we need an index that doesn't have energy in it or whatever. And you know what the problem with Social Security is? If it goes up too much again, they're going to figure out another way to recalculate it. Anything with the government I don't trust, but maybe that's just me.
Well, good news is many, many years ago, I remember all the campaign promises. They put all that stuff in a lockbox, right? So all the money's there and safe.
That's right. They said they never tax it either.
That's right.
We'd never tax Social Security. That's a benefit for you, but okay. The only problem with it, like I said, I think it's fantastic. The average person receives about $1,404 a month, and they'll get about a $27 increase a month, which is, hey, good. The other side of that coin is they're raising Medicare.
How much?
Part B. They're raising it about $25 a month. To 139 from 136 from 109, something like that.
So a net gain of minus $1?
Like $2 you gain or whatever. Now, some people were already paying $134, I believe, for Medicare Part B, so that won't change. But the majority of people that took Social Security, I think, before 2016, will now get a $26 raise in Medicare Part B premiums. So they give it with one hand and take it away with the other. But at least it's a raise, because anything to do with health insurance, they're going to raise anyway.
You're going to get the increase anyway on the Part B, right?
No matter what. And a lot of us, especially around here, we might be getting $2,500 a month. So the increase is going to be double what the increase in Medicare is. So that's good. Let's see. What else was there? Remember, a lot of people there's a confusion. When you take Social Security early, like if you take it at 62, which a huge percentage of people do, for every one, you lose $1 in benefits. For every $2 above, it's gone up to $17,040 now. But a lot of people don't understand what constitutes as wages. Okay, it's not income from pensions. It's not withdrawals from IRAs. It's not interest or dividends from your stock accounts.
Right.
It's actually W-2 kind of wages.
Earned income.
Or self-employment wages. So if you're not actually working, it doesn't matter what the portfolio is earning or what you're getting in pensions or whatever. So make sure you understand that. And remember, when you get to 66, because the full retirement age is now 67, you lose $1 for every $3 above $45,360. So it becomes much better. Then my advice is don't take Social Security while you're working. It's not good. They tell you they're going to get it back with a higher thing later, but I don't trust them.
You're losing money. You don't get the 8% increase that you would get for waiting on the Social Security. There's a lot of good reasons if you want to continue to work some, right?
Yep. Here's some more bad news. They raised the amount that they're taking the Social Security out of your check. It is now $128,700.
That's not much of a raise, though, right?
Oh, it was up from 127 too.
Right.
But remember, this thing just a couple of years ago was 118. It was 80 something just a few years before that.
Absolutely.
I remember when we were younger, it was like the first 40,000. And remember, Medicare used to cap the same thing. And that's why if you ever look at your Social Security statement, you can look at past wages, and they're capped for Medicare at a certain time. Now you'll see your real wages, well, because the Medicare is not capped anymore. They're going to make it eventually, I would guess, where it's not going to be capped.
At all.
Yeah, they're just going to, and you're not going to get any more benefit. They're just going to keep going with it.
And we talk about it a lot, though. For what we pay in, the amount that we get back, it's a good deal. You know, we're just all hoping, those of us that are getting close to retirement, that we'll get full benefits and they won't move the bar.
Yeah, it's on your Social Security statement. But if you look at it, thinking if you max it out for 30 or 40 years, you might have put in $400,000 or $500,000, and you're going to be getting $3,000 a month, $36,000 a year putting in for that's, and then a spouse gets it too. So it's a good deal, period. But knowing the government, it will not be a good deal. But just remember, if you're self-employed, you got to take out 15.3% for these. Employer pays half. You pay 7.65. The employer pays 7.65. There's also that 0.9 increase for Medicare when you go above 250 for married or 200 single. So you're going to pay almost double Medicare. You don't get a Medicare Gold plan. You get the exact same one as everybody else, but you got to pay double. So think about all that stuff. So that is good news for most people, especially around here. You are going to get a raise that most of it won't be offset by the rise in the Medicare Part B cost, but it could. All right, the next thing on the agenda. There was an article this week that I read that was interesting. It said our McMansion obsession is subtly wrecking our mental health. In the old days, in the 1800s, your house occupied about 5% of your lot.
Right.
1975, it occupied about 13% of your lot. Now it's 25. If you go in any major city or any newer cities, it's 50 or more. So they basically just get rid of it. Remember, we were talking about this before. My parents, we had a house off Burgundy Avenue, which is the first North Street at Preston and Royal. It's in Preston Hollow. All rich people now, right? Or rich big houses, right? Back then, the average home was like 1,800 square feet, was considered a pretty good sized home, and they had a half-acre lots.
Right.
Now the lots are going for $700,000, $1 million out there. But that's what the difference is. It's 0.3 acres, 1,800 square feet. Now we got 2,000 square feet on 0.2 acres. If you go to like Prosper, where I live, man, the average home is like 4,000 square feet.
Well, to me,
less than 0.2 acres.
The definition of McMansion is a house that's probably the size of the lot, right?
Yep.
Just in a real expensive area.
Right. And what they're saying is what this has done is it's making people stay in the house more. And if you're staying indoors, you're probably focusing on more TV, social media, stuff like that. And said those have definitely shown to have detrimental effects on our mental health. Said the visual beauty of trees and grass encourages peacefulness, reflection, blah, blah, blah. But he said we're not exposed to nature. The biggest thing is on our children. They said children having a yard to play in gives them freedom from their parents and room to explore nature and all that kind of stuff. If they're spending more time on their social media, if you have any kids, like I've got 3 kids, smaller, I got 4 total, but they'll spend every waking second on their iPads, iPhones, all that kind of stuff if you don't put a grip on it. Even when you do, they're sneaking it. My son, the Prosper ISD up there, if you get your phone taken, I think you got to pay him like $25. And he goes, it's a racket. I've already paid $75 this year. I go, well, why are you taking out your phone? Obviously, it's against the rules. Quit doing it. All right. That's our thing. The next thing I'll look at is this is the anniversary, 30-year anniversary of the Black Monday. Right? That was this week. Black Monday is when the market lost 23% in one day.
Is that the 29th or?
It was, I can't remember what it was, the 30th, I think. 19th?
19th, okay.
Yeah, this is the 30th year, and
that was the engineer, if you didn't know who that was, whispering. 19th.
The market is moving up into kind of similar territory, and so a lot of people are starting to compare the two. But what I did was I created a difference. What is the difference between 1987 and now? Besides, I don't have any wings anymore as a hairstyle. The 1987, they had a few things that we have a few things now that we didn't, and it was a direct result of the 1987 crash. The reason I'm going over this is I had 2-3 people call me this week, clients, and they said, okay, I know your managed program protects you because it gets you, if anything goes below its moving average, it's out. But how does it protect if it crashes like 50% in one day? What did it do in 87? Well, 87 was the worst one-day drop in history, and it was 20% or whatever, right? In 2000 to 2002, it was a gradual drawdown. Much quicker in 2008, but it still took several months.
It took, several months.
Several months to go through. So, in other words, if you have a protective system, you should be okay. It'll still get you out. It's not going to get you out of the high or get you in at the low, but it will protect you no matter what, okay, because it usually is gradual. But the difference between now and then, the reason why we don't think the flash crash would occur or less likely to occur is in 1987, they didn't stop the market. If it goes, it goes. If it goes down 90% in one day, it's going to go. Now, if the S&P drops 7%, trading is halted for 15 minutes. Unless it's after 3:25, which is 2:25 Central Time. Then they stop for the day. If it goes down to 13%, it stops again. Okay? Then if it goes to 20%, trading is suspended for the rest of the day. And that also carries over into the overnight markets and the 24-hour markets. And those things are make a big difference maker. Remember a few years ago, we actually hit one of them, and it stopped it from going down. It started going back up, down maybe 3% for that day.
And then other times, with the futures going down and all that, when the market opens, it goes down a bunch immediately.
Right. You got gap openings. That's why the option trading game is not perfect. So I say, no, I'm going to get out at this price. I'm getting in at this price because I've got an option for that. Not if it gap opens on you. If you got a stop loss, the stop loss can be ran right through and go right back up. And so you could lose a fortune on a stop loss thinking that you have this built-in protection feature. But there's another thing. They used to have this computerized programs that automatically, once this price hit a level, all the computers turned on and sold everything. Well, they don't have that anymore. They got rid of that. Also, interest rates were very high in 1987. They're very low now. So my point with that is you could get 10% on a 10-year treasury. Why am I in this dang market if I can get a 10-year treasury, right?
Absolutely.
We know it's made 4% for the last 17 years. I'll take a 10% treasury all day long. Well, that's a big comparison. Right now, people don't have a choice. People ask me almost every week, why has it gone up so far? Because, you guys have been talking about it being overvalued for years. It still ain't going down. The main reason is people don't have a choice. I got a 1% CD, a 0.1 money market, 10-year treasury is a 2%, 2.3, I think, right now.
There's no choice, and it perpetuates because everybody puts money in their 401k, so there's money going in.
And back then, also, the central banks had a tight monetary policy. They were raising interest rates on purpose. We have an accommodative one now that's keeping interest rates low. Last time I've seen them raise interest rates at those kind of levels was the 80s.
Until they have to start selling off their securities.
Right. So what was in 87? You had high inflation. Inflation scares the crap out of people, and they're likely to pull a trigger quicker. We'd have low inflation right now. The last one, I don't know if this really matters, but I've read it several times because the presidency is tied to the stock market. I even heard Trump lately said, well, if you don't pass this bill, the market's going to crash. Never heard that before, have you?
No.
He said, if you don't do that tax bill, because it's baked in, and it is true, this big run, 20% now, 25 since he got in, is tied to the thought that lowering taxes will help the stock market, which is true. But if it doesn't get passed, you can knock off all that at least, right?
Yep.
All of it is based on the overvaluation of the market, stuff like that. So 1987 and now are completely different. Sometimes history can tell us certain things about maybe future price movements. But when you start going way back there, that's why sometimes some of my software will show what happened in 1929, 1918. What does that have to do with anything? Back then, not even 1% of people in the United States owned a stock.
Right.
You know, it was only the richest people in the world owned stocks. Doctors didn't have to go to medical school to operate on you. It's a different world. So I wouldn't worry about an 87 crash like that. I would worry about a correction. A correction is totally different. You remember, Guy and I have talked to you guys, our audience, for many, many years. You can't use the stock market to pay bills. How many times have we said that, Guy?
More than you can count on your fingers and toes.
It's because of, we always say the value is fluctuating. So if you're taking out bills, let's say you got $1 million, taking out 5% out, right? $50,000 a year. If the market drops 50% like it has twice in this century, well, you took out 50 and you got to take out another 5, so you're at 45% of your principal. So even if the market makes 20% the next year, you can't catch up. We call it the death spiral. The legal jargon for that is sequencing risk. We just remember this. If you hear our bumpers we've had on this show, we try to talk in plain language. But the truth is, it's sequencing risk is the real thing. And there was an article written by Wade Pfau. He's the head of retirement income at the American College. They do this, CFA and all that stuff and CFP stuff. But we've said this all the time because, remember, we're telling you using fixed income, a guaranteed income source for your bills, is the best way to retire. Taking it out of a stock and bond portfolio that can fluctuate, it will not work ever. Yet, you hear your Ken Fishers, Ken Murray's, things like, annuities are the worst thing in the world. Well, annuities are just another fixed income piece that provides you a guaranteed income stream. Remember, you can use bonds. They're just not paying much. You can use CDs.
Today, fixed annuities are paying you the most.
But they'll tell you everything needs to be in their stock and bond portfolio. You can call every advisor they have, and they say, absolutely. No annuities, no this, everything is stock bond. Now, they might have some cash in reserves, but everything stocks and bonds, even though we've seen Thaler, that won the Nobel Prize for Economics, say, don't do that. There's two other Nobel Prize people, almost the MIT professors, and now Wade Pfau says you can't do it.
The Harvard Review did an extensive article on that.
It just can't, because you can't fight sequencing risk, okay? What he did was he came up with 4 ideas. These are for people that don't want an annuity. They just want to stay in stocks and bonds, things like that. What can you do? Well, number one you could do, is if you don't use an annuity, is to spend conservatively. All right? In other words, spend very little. It said the best way that you have an aggressive asset allocation provides the highest probability of success if the spending level is pushed beyond what bonds can safely support and if annuities are not otherwise considered.
Well, let's put a number to that. We always talk about the new number, right, is 4%. If you have $1 million, you can take 4% per year, which is $40,000 per million. Now, we know that doesn't work with sequential risk. So what's conservative, 2%?
2.8, 2 to 2.8
so,
is what they're coming out with.
So 25, call it 2.5. Yeah. $25,000 per million is what you can draw.
And we've told you that on the show before. You don't have to use an annuity. You don't have to use anything. If you can afford $25,000 a year, you can put it in pretty much anything.
Per million.
Yeah. All right. But what it says is, fearful retirees may be spending less with aggressive. You would think people would spend more. They actually spend less because they're afraid of the sequencing risk. They're afraid, what if it goes down, right? So they spend less. If you have an actual retirement income plan, you'll have a more enjoyable retirement because you'll be spending more. But basically the aggressive portfolio, conservative spending strategy can be rather inefficient. As the Safety First School argues, there is no such thing as a safe spending rate from a volatile portfolio. We were just asking that. What's a safe spending rate?
Yep.
2 to 2.8. It used to be 4. Now they're saying there's no such thing. All right. While the approach seeks to mitigate sequence risk of returns, it can actually increase the sequence rate of returns. There's no lever to provide relief from a market decline. The only solution is to sell more shares to keep spending constant. So spending conservatively, that's one, which is very difficult to do. The next one is maintain spending flexibility. All they're saying is you can't take hardly anything out when the market's going down. The same thing we're telling you. So that's why I want something that provides income. I'm telling you, are they going to cut your electric bill in half because the stock market went down? How about your water bill? You know something? We're going to cut it in half because the stock market went down.
No,
They don't care.
You may be listening and thinking that, talking about not being able to pay the electric bill or the water bill is kind of silly, but I promise you, Victor and I see hundreds, thousands of people. And the more money that a person has saved, with a few exceptions, generally means the more their bills are, the more their expenses. So the percentage of $20,000 to $25,000, 2 to 2.5% per million, doesn't work for them either.
No. What it says is sequence risk is mitigated by reducing spending during a portfolio decline. If you can do that, so okay, think about this. If you don't want a bond or an annuity or something with just a guaranteed income coming in, you have to spend less when the market goes down. That is easier said than done, right? Because remember, you're only taking out 2 or 3, 4% anyway, and now I've got to reduce that because the stock market went down, and you have to wait till it comes back. But it always comes back, right? Last time it took the S&P 5, 6 years to come back.
Yeah.
So you had to wait 5 or 6 years spending less. Now, this is your retirement. You're only supposed to enjoy it.
And you're getting older each year you're waiting.
That's right. The NASDAQ, though, remember that. More people had NASDAQ stock than S&P stocks back in the 90s.
Oh, yeah.
And that thing took 8 years to come back. And so the last thing is reduce volatility. All right?
So you're 70 years old, the market crashes, and you got to wait to 80 before you can get back to what you were spending at 70.
That's
and
right.
now inflation has kicked in.
That's right.
You're screwed.
And it says what they say is the next thing you can do is reduce volatility. This is if you're trying to stay away from your traditional bond income, or let's say you're doing it on dividend income, or just stock growth. That's what they're talking about. You got to slow down your spending. All right. Here's what it is. When you reduce volatility, essentially individuals should not expect constant spending from a volatile portfolio. Those who want upside and thus accept volatility should be flexible with their spending and should make adjustments. Retirees can reduce volatility in several ways, at least on the downside, and at least when the volatility could have a larger impact. Spending can be kept constant if the portfolio is de-risked. This is what we've talked about a lot. You got to take the risk out of your portfolio as far as the income goes.
Exactly.
To really get constant spending, you should look at hold fixed income assets to maturity or use risk pooling assets like annuities. That's the conclusion to Wade Pfau, the professor of retirement income at the American College. And it says traditional pensions, consider taking the income portion instead of the lump sum. All of these different things, but everything points to every academic that you can find that doesn't have a dog in the hunt.
Fight, yeah.
A dog in the fight.
Right.
Will tell you one thing, and we've told you always, don't listen to anybody that tells you the stock market's bad. It's a casino. They're just trying to sell you gold or something else. Or they tell you annuities are bad because they're trying to sell you stock market.
Now, the exception is when we tell you unregistered securities are bad.
That's right. Unregistered securities is not a different animal. Because there's enough risk in the market itself without worrying about somebody stealing the money on top of it.
Or being liquid.
That's right.
To cash out.
Right.
Bitcoin, for example.
Right. I know there's some Bitcoin billionaires out there. I don't know how they can spend it, but maybe there'll be a day they can spend it.
On paper, they're rich.
But there's all of these detailed kind of reports. It says his last thing, by the way, Wade Pfau says is have buffer assets. Have a bunch of cash that can absorb. You can use the income out of the cash so you can keep your spending constant.
Nothing better than cash, is there?
No. And keep the market stuff where it is. The problem with that is you've lost a lot of the return. Now your overall portfolio will suffer.
And when's the best time to do that? When your account's up 20, 30% like it is right now.
That's right. And so we've talked about this for a long, long time. If you have something that doesn't have anything to do with the market, in other words, you're getting 10 grand a month no matter what happens, you'll never go broke. You can stay in the stock market as long as you want. You can withstand any kind of bear market. But if you're counting on doing the exact same thing you've been doing for the last 30 years, and I don't care how good you are at picking mutual funds or picking stocks, it is a death spiral if you're retired when the income stops, and you have to take money out of it. Now, some of you don't have to take it. They got a pension, or they have very low expenses. You don't need an annuity or a bond. If your Social Security pays all your bills, inflation will finally catch up with it, and then you might have to consider it then. But you don't have to do anything. I would just be very judicious on how you allocate, because the market is, the S&P, no matter what anybody says, is valued about double what it's supposed to be. And so there's either going to come down. Now, there's people, we told Vanguard last week, it was 2 weeks ago, said there's a market crash. Goldman Sachs now says there's an 88% chance of a bear market within 24 months. That's not
going very far out on a limb.
No.
24 months from when it's double valued that it may happen.
And it's not something just some Goldman Sachs exec put out. This is an 87-page report. Morgan Stanley just came out and said, okay, we don't think there's going to be a market crash, which is the only big one I've heard lately that doesn't think there is. But he said, expect terrible returns for 10 years.
Wow.
For the next decade. You think about it. We know market crash in 2008, and it's made double digits since then, right? If it continued like this, the market would have averaged 15, 20% for 100 years, not 8, 9. It has to come a point where after you average 15 or 16 for 4 or 5 years, it's going to have to average nothing for several to get that average back in row. And they're saying this, the best returns you can get are about 4% for the next 10 years on stocks and about 2% on bonds. Now, wait a minute. If you stretch that out, instead of just talking about 2009, we've talked about this, that the market has made 4.06 for the last 17 years.
That's right, since turn of the century.
Now Morgan Stanley's this long report saying that you're only going to make 4% for the next 10 years. That'll be 27 years at 4% growth. It's hard to disconnect because right now it's made so much. My stock accounts have made like 20-something% in 6-7 months. But when you add it all together, it comes out 4. Because those down markets, remember when the market loses 50%? It takes 100% gain to break even. So you can have a whole bunch of 20s after that, and you're just breaking even.
And keep in mind, if you're making 4% or averaging, and you're in a volatile asset like the stock market, you can't withdraw 4%.
And we're not recommending anything against the stock market. We love the stock market. We've been managing assets in the stock market for decades. We're just advocates of taking part of that money and guaranteeing all your bills are paid until you die. Once all your bills are paid and you can't go broke, you've eliminated the possibility of you eating cat food when you're 80, then the stock market is a great place to help fight inflation in the future. I'm still going to allocate it correctly. We're still going to manage the asset, try to take advantage of different sectors outperforming others. All of those things are still going to be put into play. I've just got a retirement income plan. You realize that less than 1% of people actually have a retirement income plan. They think their broker sent them this thing that said, hey, you're going to be fine, was actually a retirement income plan. All that was is Fidelity is probably the main culprit of this. They'll send you a deal and say, okay, you saved $1.5 million. You're spending $60. You're going to be fine. And if you read the fine print, all they've done is give you an average market return for the next 50 years. So in other words, as long as you make 8% a year for 50 years in a row, you'll be fine. It's a worthless piece of paper.
Very few people have a plan at all, and the number's even smaller. You can be real articulate to have an income plan.
And what happens is we confuse how we've done lately with we're fine. In other words, oh yeah, I got a plan. My guy's fine. We've had him forever, and we've done great lately. So now I'm good. It has nothing to do with it. You got to look and see if there's any holes. You have to stress test your portfolio. You have to put a stress on it on purpose and make sure it holds. You have to factor in inflation. You have to factor all of those different issues into your plan. Don't hesitate to call us. We've been more than happy to prepare one for you, show you if you're on track. At the very least, you'll get a second opinion shows that you're doing fine. 972-715-2424. Again, 972-715-2424. You can always go to our website at ilovemyretirement.com. If you'd like to email us, it's info@mcclurecapital.com. Well, I want to thank everybody for listening to the show this week. Don't hesitate to call if you have any questions. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.